Hi, friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street, here to give you the skinny on the world's highest paying jobs and most prestigious career paths. So today, at long last, we are covering equity long-short hedge funds, which is, I think, what most people probably think of when they hear the word hedge fund. And it's kind of ironic because I think we recorded the episode, What is a Hedge Fund? It was like episode 8 or something like that. And here we are, like 80 episodes later, finally getting to this investment vertical. We're going to sit down with David Semenza, who is the co-founder and portfolio manager at a single manager hedge fund. And we'll get into what that means, especially compared to multi-manager hedge fund. It's called Islander Capital. And he was previously at Cerberus, but made the unusual and I think really interesting choice to move from the world of private equity investing to the world of public equity investing. So we're going to talk through his decision to do that, what led to it, the differences between the two worlds. And I think this is absolutely just a phenomenal episode for anyone who's interested in, again, what I think the traditional view of what a hedge fund is and does. But first, Kristen, let's catch up. What's going on with you?
Well, I'm very sad. My brother, who I talk about all the time, is officially moving to Scotland. So he's ditching me and is taking my niece with him, and my sister-in-law, who I love and I'm going to be devastated, is leaving us. So he came this past weekend. We had like a goodbye party weekend, and I don't know, I was like sad. I am not one of these people that get emotional, but I was like crying as they were leaving.
Oh, that's so sweet.
Well, no, I mean, it's funny because I'm 40, and we lived together under the same roof for 18 years, or I guess 16, because he's 2 years younger than me. Then we went to the same college. Then we lived in New York together. Then I moved here, and that was a little annoying, but they came and visited. And like I said, I have my niece, and she's just like a year younger than my youngest daughter. And I want them to be friends. Now they're going off to Scotland. He took a job there. So I'm a little sad about that.
Well, you have to plan a trip to go visit them, because I know John loves to golf. So you guys can go there and John can golf and you can visit them. And fun.
It's funny. The one thing is, like, there's only so many months or weeks in the year that the weather there is nice. It's a very
you mean
rainy
like
climate.
minutes in the year.
Minutes in the year. Yeah, I was giving him shit for that. And I think his wife, like, they're two of the most adventurous people. They're always doing something. They're either hiking or they're flying or they're always on the go. So they're excited about like the chance to go through Europe and travel. But it is the weather. I mean, like, I would be clinically depressed if I lived there. I need sun. So we'll have to time it when it is not raining every day. But I don't know how many days there are like that. So
my husband has a British stepmother. So he grew up watching a comedy called Little Britain, which is British humor, like very over the top, ridiculous skits. And he made me watch it with him once. And one of my favorite skits from that is they pretend to be the hotel manager at a hotel in Scotland. And they're like, if you're going on vacation and the Arctic is fully booked, try Scotland. And that's basically my impression of it. I've never been.
Yeah. Well, it was funny because, again, my sister-in-law, when they were trying to decide, should they move? Should he take this job? And so one of the things she did is she was looking up little kids with Scottish accents. So she was I guess they're so cute. So yeah, I think my niece might come back with a Scottish accent, which will actually be adorable.
I do wonder if my kids are going to have North Carolina, the Charlotte accent is very mild, but there is a little bit of an accent here. And I always wonder if my kids are growing up with one and I just can't even hear it anymore. I don't know.
I think my middle child has a Boston accent. And actually my cousin's kids,
I had a dream last night that your middle child had a British accent. Why did I have that dream? It just came to me while we're having this conversation. Oh, that's so strange.
Weird.
I had a dream that Charlotte had a British accent. Why did I have that dream about your middle child? And then
I don't know.
Just said that. That's so strange.
Definitely has a Boston accent.
Does she?
Yeah. I mean, it's also because she's little. So she still has, the baby voice, which I'm like, please never stop talking like a baby voice. But it is Boston-y. So we'll see if she keeps it. But I have no idea what a Charlotte accent sounds like. So I have no idea. I don't think your kids have it, but I also could not pick a Charlotte accent out of a lineup.
Well, that's the whole thing. It's like very, very neutral. Like if you watch the people on Southern Charm, that's for all intents and purposes like a Charlotte
I still don't even think I could pick out.
Well, yeah, it's not terribly distinct, but you're like, okay, those people aren't from Boston or New York. They speak a little bit differently, but it's like you can't quite tell. It's neither here nor there.
Well, The good news is that if they have them, nobody will know because
No one will
nobody knows
know.
what it sounds
Exactly.
like.
They'll be like, you're something.
Yeah.
So speaking of your brother, by the way, that's a halfway decent segue into talking about our guest today, because didn't you meet David through your brother?
No, I actually knew him independently.
Oh, okay.
I feel like we probably knew each other from just sort of being out in the social scene at Brown, but he was a year below me. My brother was 2 years below me, but we had a lot of mutual friends. And so Brian has stayed in touch with him and they were talking, and that's how we got reconnected. So
Oh,
I'm
cool.
super, and again, like he runs his own equity long short hedge fund. You and I have talked about how we need to get someone on to come explain equity long short. So we were like, this is a great opportunity. So anyway, we're so excited to chat with David. So why don't we go ahead and bring him on? All right. So, David, we are so excited to chat with you today. And I think you are the first person we've had on who not only works at an equity long short hedge fund, also focused on tech, which is, I think, very interesting because Jen and I want to talk about tech. But you went from working in private equity to working in public equities, right? Working at a hedge fund, investing in the public markets. And so I'm really excited to chat with you about why you made that switch. But before we get into that, I'd love if you could just introduce yourself, walk us through your background. Again, we obviously know each other from Brown. You were a year below me, but I would love if you could talk a little bit about where you got interested in finance, why you chose Brown, especially it's a school that doesn't exactly have the strongest reputation in finance, and basically how you came to be where you are now.
Sure. Thanks for having me on, Kristen, Jennifer. Really excited to speak with you guys today. So my background, when I was in college at Brown, I was interested in two things. One was soccer and the other one was investing. And I knew I was going to pursue one of those paths, and really only one of them was open because professional soccer was not going to happen for me. So investing was my other passion. I had been interested in it since I was a kid. I used to watch Wall Street Week with my dad when I was growing up, and I had a portfolio in college, and I traded stocks. And not that I really knew what I was doing. It was just more of an interest of investing money to make more money that just kind of fascinated me. And ultimately, this was coming out of college. It was really kind of the only path I wanted to go down. I was an applied math major at Brown, didn't really use any of that knowledge coming out. And I'd say kind of my experience as an athlete in sports probably played a much bigger role in terms of preparing me for my role as an investor.
I'm curious if you can talk a little bit about why, we had AJ who also, he was a football player at Brown, and he was saying basically that he was introduced to the idea of finance through his team. And so I'm just curious, sort of what are the things that you feel that soccer prepared you for in terms of finance, and how it—
By the way, that
set
sounds
you
like
up?
such a Goldman Sachs interview question. Like, how did soccer prepare you for a role as an investor?
Yeah, no, it's the biggest piece of it is mental toughness. I was a goalie in college. I played forward and goalie growing up, but in college at that point I was a goalie. And being a goalie just teaches you mental toughness, right? It's everyone's going to get scored on. It's what you do after you get scored on that matters. And it's
I
the
like
same
that.
with our industry. There's going to be highs and lows like anything in life, but the highs and lows in our industry are extreme, right? The highs they'll take you to the highest, and the lows will feel like you're the lowest thing on the earth. And if you don't have that toughness, the resilience to get through that, you're really not going to survive in the industry. So there's a lot of smart people and there's a lot of hungry people, a lot of people that want to do this, but it's the people that can sustain kind of those highs and lows and get through it and learn from it and get better that ultimately are able to make a career of it.
Oh, that's so interesting. So, okay. So when you graduated, did you start in private equity? Am I like, so
That's
that
right.
was, yeah, that was
So
pretty
the
rare
summer
back
before,
then.
yeah, the summer before my senior year, I interned at a firm called Nautic Partners, which is a middle market private equity firm in Providence, Rhode Island, started by a couple of Brown guys who I've stayed in touch with even to today and think the world of. Really smart people. And they didn't have kind of the same New York attitude in terms of their perspective on life. They had much more kind of balanced lives. But really enjoyed working there for the summer and getting my feet wet. I didn't know what private equity was going in. I'd been introduced to the principles from a friend, and was really excited by the end of summer in terms of just the amount I learned and the work that they were doing. And I knew it was something I wanted to get involved with. And so there weren't a lot of private equity jobs out of school. Typically, you would go through an investment banking program. And then after a couple of years there, a subset of those people would be able to go on to private equity. This was somewhat unique. Cerberus was a big fund in New York, and they had decided they wanted entry level people on their private equity team that would work really hard and learn a little bit along the way. And so I interviewed there and went through the whole process and was fortunate enough to get an offer. And the folks at Nautic had given me a very nice recommendation, and they knew the principals at Cerberus. And one thing led to another, and I ended up working there straight out of school, doing private equity and distressed investing.
Oh, that's so cool. So I'm curious then, what made you decide to make the jump from private equity to public equity? I feel like, just to give you the backstory, I feel like everyone that we talk to these days is so laser focused on private equity. And I always thought like going in, I mean, I worked with financial sponsors and ultimately was like, I want to go work for a hedge fund if I'm going to stay in traditional finance. I ultimately went and taught. But I'm curious, what made you decide to make that leap?
There's a lot behind that question. What I tell you in terms of your comment about a lot of people focus on private equity, I've seen over the last 15 years that kind of wax and wane in terms of
Mm,
public markets is more interesting, private equity at times. And I think in environments like this, and we've seen a lot of volatility the last 5 years, in environments like this where there's a lot of volatility and a lot of funds that are going under and a lot of people that are losing their jobs, private equity seems like a more interesting bet in terms of you have locked in capital and they tend to be just more stable work environments versus, I think environments where that are not as volatile, public markets is interesting because you can rise very quickly and do well very
mhm.
quickly, and there's a golden opportunity. And so I think the main thing is people need to figure out what's a best fit for them, regardless of the environment. Don't be as focused on what's the cool thing at the moment. When I made that move to public equities, it was not a permanent move in my mind. It was really, I wanted to try something different. And so Cerberus was this great opportunity to kind of learn from scratch, really investing and modeling and all the technical skills that went with that, and think about risk and a lot of those fundamental skills. A great place to learn. But after a couple of years, just the intellectual curiosity in me wanted to try something new. And when I
Mhm.
met with the Matrix folks who had been introduced through a headhunter, what intrigued me most was A, really interesting people, and B, completely different than Cerberus, right?
Mhm.
I went from a large firm where you're part of a huge team and you're doing a narrow role to a very small firm that's doing growth, tech investing, and everybody has kind of an outsized impact on whether or not the firm is successful. And so really just kind of doing something different at a young age I thought would be great for my development, my knowledge.
Mhm.
And my perspective at the time was I do a couple of years at Matrix, and at that point I'd have a great perspective of what I wanted to do long term, just given my exposure to different areas of investing. And so that's really what drove me to Matrix. I think ultimately what kept me in the public markets was there's a number of reasons why it was the best fit for me personally in terms of my personality and what I wanted to do. Private equity, the thing that initially drove me to private equity was the idea of working out with teams, right? And being a team sport person, growing up playing on teams,
Mhm.
the idea of working with a team seemed intriguing. I think the part that didn't fit me as well was when private equity, you make an investment and it takes several years to find out the success rate. And a lot of times firms look very different by that point anyway. And
Yeah.
so I think the public markets, there's much more of an instant feedback cycle in terms of if you're doing
Mhm.
well or not. And being a competitive person, I really enjoyed kind of that high energy, high intensity environment. It's not for everyone, but I think being in that was a better fit. And the other things I'd just say is from a curiosity standpoint, I really enjoyed the day to day in terms of in public markets, every day is a new challenge. If you kind of get stuck in your ways, you become irrelevant very quickly. That's just the nature of it being a highly competitive industry. So every day, every month, every year is a new challenge. If you're not getting better, you're falling behind. And I felt like that was very interesting. And then the other aspect is just the people you meet in our industry, where in private equity and distressed investing, you get really great access to management teams and great people, but they're not always companies that are changing the world, right? A lot of these will be more
Mhm.
mature companies that are kind of ripe for private equity to optimize. In the public markets, it's all about forward looking, how the world's changing. And so you're meeting with companies, with entrepreneurs, with people that are really at the edges of industry and change. And
Mhm.
so being involved and having conversations with them, I just found very stimulating because the learning that goes involved with it is very interesting.
Oh, that's so cool. So we've had other people who work at hedge funds or started their own hedge fund in the past, but you are our first equity long short person. So can you just explain, I guess, like at a very high level, what the strategy is?
Yeah, so equity long short has certainly evolved. There's different types of equity long short funds. And so the whole idea behind equity long short was in theory, you can make money in any market, right? If bull
Hmm.
market, bear market, because you're going long and short, is there's always opportunity. And so it's kind of put in this absolute return bucket by a lot of allocators where it's looking to generate absolute returns regardless of what the market does. That's definitely oversimplifying kind of where it's gone. What we are is what's called kind of a long biased, a long short fund. So while we do have a long book and a short book, we are net long in terms of our long book is larger than our short book. And in general, we are playing for markets go up over multi-year periods. And we want some beta, some exposure to that. And so we will be long biased. And on the short side, it's more opportunistic of, finding ideas that, given a set of circumstances, can make money on the short side, which is a stock going down. And so that's kind of the way to think about it. There are very large multi-manager funds, things like Citadel and SAC and others like that. And they tend to be what's called beta neutral or factor neutral, which is a lot of their exposure on the long side really matches 1-to-1 their exposure on the short side. And that's different than what we're doing at Islander Capital, which is being long biased. So, what does that mean? For example, if we have $100 to invest, our long book will probably be roughly $100 in terms of invested capital. It'll probably be spread across 15 to 20 ideas. We'll probably have half the capital in the top 5 or 6 ideas. So it'll be fairly concentrated. And that'll be the makeup of the fund. And then our short portfolio might be $40, $50, $60. It'll be across 10, 15, 20 ideas as well. Those ideas will be a little bit more catalyst rich in terms of our long book is typically turns over a multi-year period. Our short book ideas are typically in there for typically less than a year. So that's the main construct of the portfolio. And that's really our version of long short, how we're going about it.
I would love to understand a little bit about how you actually decide what companies, what names to invest in, sizing. Obviously, you don't have to give away any trade secrets or, but I just want to understand how much is fundamental analysis in the sense of comps, DCF, how much is sort of a gut feeling, how much is looking at just the story. Are there technical factors that go into it? What are some of the things that are driving your decisions about making an investment in XYZ company or ABC company, what have you?
Yeah. So again, different strategies, different hedge funds. We are definitely a fundamental focused firm. So we are not technical experts. We're not chart readers. It doesn't mean that that's not a way to invest. It is. It's just not what we're set up to do. So we're fundamentally focused. We do a lot of our own work in terms of building our own models, our own fundamental analysis. But from there, primary research is really the difference maker, which is we get out in the field and we've built incredible networks over the last 10, 15 years within our core sectors, which is really TMT, technology, media, telecom, which is our core sectors. And we're having regular conversations about changes that they're seeing in their industries. And we're trying to triangulate those different data points to form a variant perspective on idea. And so what do I mean by that? Yes, like I said, we're going to build a model. We're going to build a DCF. But if our business was as simple as building a model, computers would do it. There's obviously needs to be a human aspect to what we do. And I think that's why it's much more of an art than a science, kind of our job at the end of the day. And so we will ask questions about, how industries are changing based on new technology, how industries are changing based off of new competition, things of that nature. And again, trying to really find businesses that are at inflection points, either for the better or for the worse, that aren't properly understood by the market. And that's really the process that goes behind it.
And really dumb question. When you're having these conversations and you have these relationships, with whom are you speaking? Are you speaking to the CEO of a company? Are you speaking to research on the street? Who are you talking to?
Yeah, so oftentimes we will talk with the CEOs, CFOs of companies, and that's a really important conversation to have. Now, look, the CEO of a company will talk with a lot of investors, right? They'll talk with dozens or hundreds of investors, but they'll only remember a few of them. And so whenever I hire people, what I would tell them is, whether you're meeting with a management team in a group meeting or one-on-one, either way, they're only going to remember a few folks. You need to be in that small subset. And you need to be in that group that when you talk, they listen. And it's very hard to do that. And so the importance in doing that is you need to understand their pain points, right? You need to understand what keeps them up at night. Because if you can do that, then you've got their attention, right? That's the connection that you're trying to make with a management team. And that really comes from, deep domain expertise, understanding, what makes businesses run, and also understanding how management teams think and how their strategy has evolved. And so when you do get that moment with the management team, you're able to form that connection. And ultimately, they want to meet with you on a regular basis and have deep conversations about, again, what keeps them up at night and ultimately what's going to make or break their business, right? What's going to define success. So those are very important conversations, but it's much broader than that, right? We'll talk with former executives that we've built relationships with over time. We'll talk with entrepreneurs that are trying to disrupt a particular sector. We will talk with sell-side research analysts, but I wouldn't say that that's really the heart of our process. Really, what that can be great for is understanding how other investors are thinking, right? Because sell-side research analysts will talk with 50 investors and they'll understand both the bull and the bear thesis in any stock. and you can walk through, what are you hearing when you talk to other investors, right? How do they think about this? How did they react to the guidance? Did they believe it? Did they not? And so the whole psychology element of our job, right, which is understanding how investors think and how they're going to change, that's ultimately can be sussed out by, a couple of good sell side calls with the people at the banks.
I have a dumb follow-up question to that. When you've got these great relationships with the CEO and then you're short the stock, how do you navigate that?
Yeah, that's a much more complicated one, because when you're short a stock, obviously that's something that you hold a lot closer to the vest. You can still have a productive conversation, right? You can still have a conversation that you're adding value. So I tend to not talk about our positions. If we're the top holder in a company at our old fund, we would obviously talk about that. It's in our 13 Fs. But in general, whether we're buying or selling stocks, we try to leave that out of it and just stick to the point of, let's go through the business and what are you doing to execute on the opportunity, and what are the risks and how you're incorporating new technology and things like that that are typically particularly relevant.
And so actually,
these are all really good questions, Jennifer. They're so good that I can't provide you good answers for them.
Well, actually, to speak with what you were just saying, because and our listeners may or may not know this, but obviously if you have a sizable position, you have to file that 13F. What is the threshold under which you don't have to file?
Well, even back up a step. What is a 13F for our listeners who are not familiar with one?
So a 13F is, we're still getting off the ground, so we're not at that point yet. But essentially, when you end the fiscal year at a certain asset base, you have to start filing 13Fs. And so that means every quarter, 45 days after the end of the quarter. So let's take, March 31st, for example. By May 15th, you have to essentially disclose all of your long U.S. public holdings. Anything that's listed in the U.S., you disclose that in your 13F. Now, it doesn't tell the full story, because if you have options, derivatives, other things, that's obviously not included. Your shorts are not included. Cash balances are included. So it doesn't tell the whole story, but it does tell the bulk of your long exposure. And that gets filed publicly. It's on Bloomberg. Everyone can see it. So that is available. Yeah,
and that's regardless of the size. Basically, anybody who has a firm or an investment firm is going to have to file that, or is it only for
once you hit
types?
a certain AUM threshold, and you're registered with the SEC, you have to file a 13F. Exactly.
Got it.
Now, there are other requirements as well. So in certain European countries, you do have to disclose short positions. And that's country by country specific. And it's based on certain thresholds. If you're short a certain amount of the stock, you have to file it privately, so just the regulator can see it. And at certain thresholds, it becomes public. And so there are that out there. There's been legislation proposed in the US historically about disclosing short sales. It would obviously be very disruptive for our industry if that happened.
Yeah.
So for now, it's allowed to stay fairly private. And then the only other aspect I would add is companies typically get regular custodial reports. And so they can see where the stock is held at what brokerage. So let's say you have UBS as a prime broker and you're a big holder, and they see a lot of stock move out of UBS. A lot of times companies can figure it out in more real time that you're moving stock in or out just based off the custodial reports that they get.
Oh, this is so interesting.
So that actually leads me into my next question. We talk about leverage in very vague terms a lot, and we haven't really talked about it in the equity long short space. And I'd love if you could walk us through how it is that you guys employ leverage. We've touched on prime brokerage from a number of different angles, but obviously when it comes to sourcing liquidity and sourcing borrow for stocks, this is a pretty critical part of the math. And I was wondering if you could give us a little bit of a crash course in that and how you employ leverage and also the mechanics of getting short.
Sure. When you work with a prime broker and you set up with them, you come to agreements up front. And there's all sorts of thresholds that you're agreeing to in terms of your exposure limits. And there's also other protections in place in terms of individual security, exposure thresholds. Even within a sector, if you're over a sector, they're going to watch out to make sure that they're not. And what they're really protecting for is extreme scenarios. Like you guys have probably heard of Archegos, which was a very large family office. And they had all sorts of relationships with different banks. And the banks had visibility on their relationship with Archegos, but not the full balance sheet of Archegos, right? And ultimately, there was a lot more leverage being employed using things called swaps than the banks realized. And when it all got unwound, the banks literally lost billions of dollars. And so that's a very extreme case that the banks are trying to protect themselves for. We are not a fund that uses a high amount of leverage. Typically, our long portfolio does not go above 100%. Like I said, we do take on some beta. We do take on some net long exposure. And it's very different than a lot of these pod firms that they'll run with gross exposure of 3, 4, 500%, right? Gross is your long plus your short. And part of that is they're hedging out for factor risks and market risks and other variables. And so in black swan events, they should be much more hedged. And those large exposures should not, potentially unwind the fund. We want to be careful because in a black swan scenario, we want to make sure it doesn't do permanent damage to our business. And so typically our gross exposure will be, 150% or less, and our gross long will be in the 100% or less range. And that's how we manage risk. And that will help us with drawdowns in the market so that we're not in a position of weakness. Now, in terms of, what is shorting stocks, like Jennifer brought up. So the way shorting stocks works is you effectively are borrowing stock that somebody else owns. You are selling it then to a third party with the agreement that you will then buy it back at a future date and return it to whoever owns it. And it sounds simple, but it actually is complicated and it comes with a lot of risk. For example, the bank that does this, they have the right to call the stock. So what does that mean? It means, okay, you've borrowed it, you sold it to someone else. Well, whoever you borrowed it from wants it back and you have to give it back to them. Well, you don't have the stock because you've sold it to a third party. So you either need to buy it back from a third party or borrow it from another bank or find another way to source it. So that's a risk for it. Another thing is borrow cost, right? If
this is something we never talk about because we talk about repo rates, obviously in the fixed income world, because that's my background, but we never talk about borrow costs on here.
Well, I know who we are. I used to, I worked in convertible ARB, or I didn't work in convertible ARB, but like as someone who was pricing converts, like the stock borrow was a huge part of that.
Right, but we've never talked about it on here.
We haven't,
and
you're
it's
right.
something
This
that kind of falls by the wayside and gets brushed under the rug. You just borrow the stock, for free?
Yeah.
No, there's a cost of carry for this.
Yeah.
Right. So when somebody lends the stock to a bank for you to borrow, typically the bank will pay whoever's lending that stock to them some sort of fee for doing that. And so the bank needs to be made whole on it. So you are paying a borrow cost. And if it's an easy to borrow stock, it'll be GC and it'll be fairly cheap. But if it's a hard to borrow stock because a lot of people are short it can be very expensive and it can change. It can be 1% today. And guess what? Everyone wants to borrow it in a week from now. It could go up to 5%. And so that can change on a regular basis. And so typically, let's say you're spending 1% to borrow the stock. So if it's $100, you're paying $1 a year to borrow it. They might kick back half of that to whoever is lending the stock to the bank. And the bank keeps half of that and everyone's making some money and everyone can go on with their lives. So that's typically how it works. Now, there's a flip side to it though as well, which is when you sell the stock to someone, there's something called a rebate, which is, let's say you sell that stock for $100. That $100 is now cash being held at the bank. And that used to be worth nothing because rates were at 0, but now rates are 5% and there's value to it. So you'll get what's called a rebate for doing that. And so while it used to cost you a lot of money to borrow stock, you're now getting much more in rebate than the cost of the borrow. So shorting stocks has actually become much more lucrative because you're getting 4 or 5% on that notional value that you weren't getting when rates were at 0%. And so I think it's to some degree, it's made long short more attractive because shorting used to be very tough. You have to make a stock go down in an up market. Now you are getting some income along the way, which just helps make the numbers work a little better.
And you also have to pay dividends too, right? So if they pay dividends, you have to, it's coming out of your pocket. So
exactly. So if you short, that's the difference between a stock and a bond. So for a bond, a bond pays interest, for example. And let's say you hold a bond for 45 days, you get interest for those 45 days. If you hold it for 80 days, you get it for those 80 days. And if you're short it for 45 or 80 days, you're paying out the interest on those 45 or 80 days. With dividends, you only get that payment if you hold it the day that the dividend goes out. So if you hold the stock for 88 days, but you don't have it that one day during the quarter it goes out, you don't get any dividends. And it's the same with shorting stocks. If you're not short it the day the dividend goes out, then you're not paying the dividend. There isn't a daily accrual the way there is in fixed income. Now, that being said, there are ARBs on the street that take advantage of this. So if you think you can just buy stocks the day before the dividend goes out, and sell them
I was going to say,
it's not that simple. There are people, there are computers out there that have figured that out. And so the stock prices will adjust for dividends. Yeah.
Got it.
We actually recorded an episode earlier today talking about some of the price action that we've seen in the equity markets in the last 24 to 48 hours. and the topic of factor rotation came up. This is something neither of us are experts in, but you mentioned the term factors in the context of beta, I think 2 or 3 times earlier. I was wondering if you could talk us through that factor theory and what exactly that is in the world of equity long short trading.
Yeah. So if you're in a factor neutral fund, like what we're talking about, a Citadel, a 0.72, and you have requirements to be factor neutral. So what does that mean? It means if 60% of your long book is in large cap, 60% of your short book has to be in large cap. If you have 30% healthcare on the long side, 30% on the short side, there are all these boundaries set up to effectively hedge out these other risks. And in the process, it creates a lot more restrictions on what you have to do. And what's happened over the last couple of years is these platforms have gotten a lot more capital and they use a lot of leverage. So if they have $100, they might have $500 of notional exposure across their long and short book. And so what happens is when the platforms would sneeze, it used to be everyone catches a small cold.
Yep.
Now when they sneeze, everybody gets the coronavirus
Yeah.
because they're just so impactful. And it's only getting more extreme. And so, and then to take that to another aspect is, let's say Kristen is really good at trading Procter and Gamble, right? And the platforms know that. When she buys Procter and Gamble, there'll be an algorithm that buys more of it for the platform, right? There'll be a box behind her. Right. And so what it does is it creates this spiraling.
Yeah.
And so when there's a rotation at the platforms, somebody wants to reduce their NVIDIA exposure, there's huge spiraling because they have so much capital and using so much leverage. Exactly. Yep. And so what we're seeing now is we're seeing these violent moves around, Tesla has an earnings print that disappoints and all of a sudden everything in tech goes wild, right?
Yeah.
And it's a function of the platforms have all these factor requirements. And now that they have as much capital as they do, they completely swing around the equity markets. Now, for me, that's exciting because that's volatility that's not based on fundamental changes, right?
Yeah.
And so as long as we have a healthy balance sheet and we're not over everything else, we can use that volatility to add opportunistically to our positions.
Sure. That makes a ton of sense.
That's so cool.
And so for the idiot me parroting back to you what factor is code for, it's really code for how you categorize different equity markets, right? So it's either large cap, healthcare, like you said, factors being these sectors, categorizations, et cetera, et cetera.
Exactly. They're beta exposure, like all sorts of things, the US versus Europe. So all these different factors that they solve for, with the idea being that if there's a black swan event, they're fully hedged for that, right? And they're going to do fine. And to their credit, they did very well in 2022, right? In terms of these platforms.
Yeah.
And that's why they got this huge amount of capital in 23, 24, and why they're swinging the markets around in ways that we really haven't seen before.
Yeah.
Oh, that's so interesting. So I'm curious, do you guys, and it sounds like the answer is no, but do you use option strategy at all? Or
sounds like yes, no?
Oh, that is we seldomly will use. We've done it twice. We've been up and running for, call it 15 months now. We've done it twice in 15 months. And so in general, options, for what we do, options are almost always not the right bet. And the reason for that is the way options work is they're priced based off a number of factors, and volatility is a big one. And implied vol is always higher than actual vol. And that's how option houses make money, is they're selling you an option based off of an inflated volatility. They completely hedge it out. And so if they do it correctly, they should always come out ahead. And as the buyer of that option, you're paying excess for the right to do that. Now, that being said, there can be unique circumstances where you think that historical volatility is not representative of volatility over the next 3-6 months because of some fundamental event that will change that. And so that's when we're using our expertise in fundamental research to make money in that market. And again, so it isn't often that it happens, but if you do find those scenarios where you do see a big change in a business, a fundamental change that can really swing the valuation of a stock, and you also want to hedge out your downside risk, right? Which is what an option does. You can only lose what you put in the pot, but in theory, you can typically make multiples of that. Then those rare scenarios come along where you can buy put options because you think stock's going down, or you can buy call options because you think it's going to go up.
Got it. And so one question, it's funny because we've spoken with a number of other hedge fund managers and actually even like Jen, when we first started, we got together, she would talk about like a trader. And in my head, a trader is just like someone who's executing, like not actually taking risk. And so the point is there's different titles at different firms and the, trader has different roles at different firms. I'm curious if you can talk about just like within Islander Capital, who are the types of people that you hire? Is it multiple analysts? Is it, multiple PMs? Is it like you are the PM? I'm just sort of curious about like the makeup of your team. If you can talk to that.
Right. So we're a single manager model. We're not a multi-manager model. So I am the PM. As we grow as a firm, we're not going to hire more PMs. There'll be a single portfolio that the team supports. That's how it's set up. Now, if you're a larger firm, then you will have a dedicated trader. And so what that trader does is they're plugged into the different banks. And when you want to execute an order, they will go, into their trading platform. They'll have a software platform that they dial into, and they will execute those trades. And you can do it electronically if you want to be quiet, or you can work directly with a bank. But that depends on liquidity and other factors in terms of how they do that. And then the trader is also supposed to get color from the street. So they'll talk with whoever they're trading with, Morgan Stanley or Goldman, whoever it is, and try to get color as to flow. Is it retail? Is it institutional? What's going on? Is it short selling? Is it long onlys? And so they'll try to get flow and do that. Now, when you're a smaller firm, it doesn't make any sense to hire a dedicated trader because it would be too big of a part of your cost structure as a new firm. And we don't do a lot of trading anyway. And so you can hire an outsourced firm like BTIG or Cowen or Jefferies to do it for you. We work with BTIG. And so effectively what we are is we're plugged into our software platform. And so if I want to make a trade, I will put in stock XYZ. We want to buy 100 shares. Here's the limits, or however I want to set it up. Our counterpart at BTIG will then execute it. And I'll also tell him where I want you to execute it. So you could do it electronically, in which case we only have to pay BTIG, or you could work with Morgan Stanley, Goldman Sachs, one of the banks we have a relationship with, and then that bank will get a commission. And so as we grow, we want to make sure the banks get commissions because we get things in return from them. And so ultimately we direct that through our trader. And ultimately that's how the trades get executed.
Interesting.
And when you say you get things from them, because for the uninitiated, that can be easily misinterpreted.
Right.
What you mean, I presume, is you get research from them, you may get prime brokerage services from them, you may get color from them, from equity, sales coverage, et cetera, et cetera. Is that correct?
That's right. So with regards to prime brokerage, we have Goldman and Morgan as our prime brokers. So we pay prime broker fees to them. So that's outside of trading commissions. And then we also have Morgan Stanley as for something that's called a fund admin, fund administrator. And so they're effectively managing all of our LP relationships, sending them documents, et cetera. Those are separate fee pools that we are paying the banks. Commissions are paid beyond the prime brokers. And in return, on a basic level, we'll want their research. Typically, they'll cover company XYZ. We'll want their sell side research. We'll want their models. We'll talk to their analysts. That's at a basic level. And then from there, there's corporate access, which typically banks will want more for that. And so that they'll hold sell side conferences, they'll have group meetings, they'll host dinners, things of that nature with companies. And their biggest clients will have the first option to get into that sort of access. We're much more focused on our own proprietary relationships and research, but we do also work with the street and we do get some value out of the access that they provide.
We had heard from a former equity salesperson that so much of what clients wanted access to was a firm's deal calendar for IPOs. Obviously, the IPO landscape has changed considerably since the time that she was talking about being in the markets. But I'm curious, is that something that you pay attention to, the kind of IPO calendar, wanting to be involved in deals? Or are you like, hey, listen, we're only trading things in the secondary markets?
Yeah, so IPOs can be lucrative because if you can get allocations in IPOs that have a big move, they can be, there are IPOs that price attractively. And if you can get into them, they can be lucrative. So a couple of things. One, the IPO market has been fairly dead over the last 2 to 3 years. And that was just a function of too many companies went public in 21. And also a lot of private companies raised money at very high valuations. And so going public at a down round is not typically the preferred route. So even though the S&P is at all-time highs, the IPO window has been fairly shut. And so there hasn't been a lot to go on. It's definitely something that we want to be involved with. And as a smaller firm, it's harder to get those allocations. But like I said, they can be lucrative. The other thing is you want to form a relationship with management teams as early as possible. When they go public, that's when they're eager to meet new investors, right? Public investors that can be with them for the long haul. After they've been public for several years, there's less of an appetite to build relationships with management teams.
That's
So
so interesting.
you want to get involved, as early as you can. And that's why it's important to go to IPO roadshows, to go to those IPO lunches, and to try to get that relationship started at an early point in time.
And do you guys, because I know you're based out in California, so does that actually help just being able to, because obviously as someone who's focused on tech, and most tech firms tend to be out there, even if they're currently private, are you getting to like meet CEOs of these smaller private tech companies? And that's the part of the benefit of being out there?
Yeah, there's definitely a proximity benefit of just a lot of tech is out on the West Coast. So we do our best to network with private companies in addition to public companies. And, a lot of them, when they go public, we actually do have a fair bit of ongoing dialogue before that even happens. So now once a company files their S1 to go public, at that point, they are quiet. They're not allowed to talk to investors. Yeah. So there'll be a period where they get shut off from the street. And then once they go on their roadshow, then you can re-engage and have conversations with them.
Got it. One thing that this is sort of going back a little bit. My brother was talking about this like incredible Netflix trade that you'd put on in 2016. I just would love if you can talk a little bit about how you ultimately decided you thought that was a good trade, how you came to the conviction when, again, I think at the time, the resounding view was that it was expensive, and clearly you had the right call. If that's possible, I'd love if you could just sort of talk about using that as almost like a case study of being able to identify a potential investment, come up with the sizing, and then ultimately like executing it.
Yeah, of course. Yeah. So we had built a big position in 2012 and then reduced it, in 2015. Then we kind of rebuilt it in 2016. So two separate times. There were two different points of time in the business. In 2012, people actually thought there was existential risk to the business model. And,
Wow.
Netflix had just separated DVDs from streaming as two separate products. And they really kind of botched the process of doing that. And there's just a general feeling from investors that this was not a viable business model. It was never going to make money, and it wasn't going to grow to what they thought it would. And that's how it was trading. Right? It was trading almost like it was going out of business. There were 35 sell-side analysts covering it. Only 3 of them had buy ratings on the stock.
Wow.
The short interest was over 20%. And so, we bought 1% of the company when it was a $3 billion valuation back in 2012. And that really stemmed from several different data points we had gathered. One of them was just conversations we had with traditional media players, Disney, CBS, Fox, et cetera. And the question I had for them is, they said, look, you're licensing your library content to Netflix, and it's clearly impacting your linear ratings, right? Less people are watching traditional television as you do this. And, I said to them, are you going to cut back on what you give Netflix just to make sure you're protecting your golden goose? And the feedback I got from them, kind of across the board was Netflix is not a threat. We're going to sell them more content to help make up for shortfalls elsewhere in our business. And it was very clear that the traditional competitors were playing the quarterly game and Netflix was playing the 10-year game, right? In terms of what they were going after. That was really interesting to get that sort of feedback. Another interesting data point was when a lot of the AMC originals went on Netflix, this was 2011, 2012. So it was Mad Men, Walking Dead, Breaking Bad, et cetera, the prior seasons. And a new season would come on AMC, viewership went up 100%.
Yeah.
And usually for a season 4, that wouldn't happen. A bunch of new people would find it. What it showed was Netflix could aggregate an audience in a way linear television couldn't do. They could hyper-target, use their home screen, and they could effectively get twice as many people interested in a show than linear television. And so they really did have a better mousetrap, a better medium. And the legacy players were playing right into their hands by giving them more and more content. And so we saw, the basic math at the time was, they had 25 million subscribers. We saw that going to 30. HBO had roughly 30 million US subscribers at the time. We thought HBO's US business was worth about 8 to 10 billion just based off of their financials. Netflix was trading at 3. We said, if they're the HBO of the web, over the next year, people will see that, and this is going to be worth $8 to $10 billion. It sounded very simplistic, but sometimes you have to get away from kind of the weeds and just see the bigger picture, what's going on. And that's what private equity people have trouble with is they go to the public markets and they get stuck into their DCFs and their 100-page models. And they kind of just miss the bigger picture as to how things are changing. And so it's important to kind of have both aspects, right? Make sure that a company is real and that the unit economics work, but also just see how things are changing and who's best positioned, who's executing, and find that big opportunity. 2016 was a little bit different where the company had just finished launching globally at the beginning of the year. And they had a slowdown over the summer in the subscriber base. And everyone thought that meant the business was mature. And so it's a constant mistake public market investors make, which is they over extrapolate every data point. And they don't realize like growth is never linear, right? There's going to be acceleration, deceleration. And what you have to do is look at the long-term opportunity as opposed to, whether it's accelerated, decelerating at the moment. And this was just a situation where it's decelerating because they had launched a bunch of third-tier markets. And so they have a bunch of trials in Q1 in the first quarter, and the next quarter they have a bunch of cancellations, right? And it's the nature of a new market where a ton of pent-up demand, people try it out. Your most churn will be then in the next 3 months, and then you go to a normal growth rate. And people just didn't understand that. And so it was a very attractive entry point that summer, getting involved, and the stock did appreciate another 100% over the next 12 months.
Wow.
It's wild. I feel like that's, yeah.
No, but that's again, those are, you build relationships with management teams. So when they go through those periods, and the CFO, Dave Wells at the time, became, a good friend and someone I've known, eventually stepped down a couple of years ago, but someone that, I know to this day, and he's invested in our fund and someone that I talk to on a regular basis.
That's so cool. So I'm curious, what do you think are the skills that make someone a successful PM? So for our listeners who might be thinking, whatever, they're in college or in their investment banking and they're like, do I recruit for private equity? Do I recruit for a hedge fund? What are the skills that make someone a successful portfolio manager?
Yeah, so I'll start with being a successful investor, because I think that's kind of where you have to start with before running a portfolio. Is the 3 things I look for when I interview candidates. Number 1 is intellectual curiosity. They have to be constantly eager to learn, because our industry, if you're not constantly learning, you're falling behind. Number 2 is independent thinking. A lot of folks have trouble breaking from the herd. It's difficult, right? It's just people are guided out of fear. They don't want to be different and wrong, and then they're the only one that's wrong. And that's a very scary thought. That being said, I also know people that will take the other side of every argument out of principle. And if you do that, you'll get into trouble as well. It's knowing when and how to break from the herd, and also knowing, when you're wrong. You break from the herd, doesn't go your way. Are you right? Are you wrong? What do you look for? So I think independent thinking is very important. Then the last is team play. I can't tell you how many smart people I've seen come in this industry and they think they can do it all themselves, and they don't realize it's a give and take, and you need to build relationships internally at your firm, externally with other people. And ultimately that's what's going to pull you along and make you better. So those are the 3 things. I think the biggest mistake is everyone wants just the highest IQ person on the planet. And Warren Buffett had a great thing he said once, where he said, in our industry, you have to be smart, but not super smart. And super smart doesn't beat smart. And it's totally right. Like that additional 30 IQ points that you have, that's not what separates you in this industry. What separates you is just that emotional intelligence, is being able to know when to break from consensus opinion and know how to hold that viewpoint, even if something goes against you. And it's very hard it's easy to discuss, hard to do. And that's what we look for when I'm trying to find someone to bring on board as an investor. Now, the crux of your question around being a portfolio manager, that involves being able to, essentially, you're going to have a portfolio of ideas. You need to know what your best ideas are. You need to be able to concentrate your capital in your best ideas, because you're going to have 15 or 20 great ideas over a long period of time, but a couple of them are going to have kind of nearer term variant perspectives that can really move the stock. If you don't concentrate your capital in your best ideas, it's going to be very difficult to outperform the index. And so that's your job as a PM, is talking with your investment team and knowing kind of who really has an edge in the space, an edge in the research process, and where you can really generate outsized returns, and then focus your capital in that area. The toughest part is just your time gets diluted, right? When you're an analyst and you're looking at a couple of ideas, you can really focus your time. As a portfolio manager, you're in charge of the entire portfolio,
right?
And you just don't have the same capacity to go after every single idea.
And so I'm curious, are most of the candidates that you're recruiting, are they former investment banking? Are you hiring out of undergrad? Like, what is kind of the traditional candidate archetype?
So in terms of who we're going to be hiring, we don't have the resources to hire entry level people straight out of school. People straight out of school, we did a fair bit of that at Matrix. They can really provide a great perspective because they're fresh and new, and they're not jaded by years and years of work. But they also do require just more support, more resources, more handholding.
Yeah.
And you can have more problems, right? And it's more difficult to diligence in terms of reference calls, things of that nature is very difficult to do for entry-level people. And so as we grow our firm, it's going to be people that have experience, typically people that I know or someone at the firm knows, that can add a lot of value day one, and that they're not going to be, they're not going to create problems. So that's who we'll look. In terms of backgrounds, sales and trading would not be a typical background. We're a fundamental based firm. If we were, if we were a trading firm, that'd be different, but we're not. We want people that have backgrounds in deep fundamental research. And so that can be banking, it can be private equity. That being said, there really are no absolutes in terms of, a particular background either qualifies or disqualifies someone. If you look at kind of the history of the greatest kind of stock pickers in the world, they kind of come from different backgrounds. And,
Mm-hmm.
and ultimately, I think that's very indicative of our industry, which is, it's more about who you are as opposed to, where you work, what you've done. And so that's what's most important is the individual, their personality traits. Are they passionate about this? And then for where we are as a firm, are they the right person for what we need right now?
And are you looking at people, because you had mentioned how you as a younger kid were investing on your own. Do you like to see that they are investing on their own? They're passionate about the markets. Like, I assume that would be something that's, I guess, a character trait that you value. But again, I mean, some people just might not know about it. So I'm curious, like, is that something you tend to look for?
Absolutely. Absolutely. In today's world, it's so easy to get a Robinhood account or a Schwab, whatever it is, E-Trade,
Yeah.
that it doesn't matter if you got, $300 of babysitting money from high school, whatever it is.
Yeah.
If you're passionate about this, you can get access to the market. You can buy fractional shares. There's ways to do it. I'm less concerned about what they're actually investing in at that age. I don't expect college kids to actually know what they're doing. I certainly didn't know what I was doing in college trading stocks. I just want them to be interested in it and involved in learning. And if they're doing that, then that's a huge positive signal as far as I'm concerned.
It's funny because we've talked to so many people who are thought leaders in the industry, and so many of them are like, I didn't know anything about finance, blah, blah, blah. Here's how I stumbled into it, fell off the back of a cart, and now I'm a portfolio manager or head of a fund or whatever it is. You were the first person we talked to who's like, I grew up wanting to invest. I was picking stocks in high school and college. Like, this is what I always wanted to do. What was your origin story? Like, how did you said you watched the markets with your dad. Like, was he in the industry? Like, how did you fall in love with it?
Yeah. So my dad's a doctor, and like most doctors, they're not also great investors. I'll leave it at that. But it doesn't stop them from trying. So yeah, look, I was always just fascinated by the idea of being able to turn $1 into $2. And I didn't know what I was doing in college when I was trading stocks. That wasn't the point of it. It's just always a personal passion of mine, much like playing sports. It just seemed like it's something where you can measure the outcome, and that always kind of piqued my interest. So I didn't know what investment banking was when I went to college. All that stuff was kind of just learned over time through meeting people, osmosis, and eventually you find your niche, right? Which you're most passionate about, which that for me, that's long, short equity.
All right. A couple final questions. I'm curious, since you're in the tech space, like maybe you have more insight than our average person, but how, if at all, do you see AI changing the investing landscape in like the next 5 to 10 years for someone? I mean, because again, we obviously have so many people that are listening to this who want to go into whether it's investment banking or private equity or work for a hedge fund, all those kind of things. I mean, how do you see, or do you see there being less need for people? Do you think that like AI is going to replace jobs or within the investing space, or like, how do you see that changing in the next 5 to 10 years?
Yeah. So AI, we view a lot like the internet, and we're not the first person to say that, which is it's not its own sector. It just impacts every sector, right? It changes the way companies are going to operate. And, it's kind of hit this defining moment where it's gotten critical adoption, and it is impacting industries, and it's going to change our industry just like every other one. Maybe it will be doing my job one day. I don't think anyone can predict that with certainty, but I'm a big believer that our job is more of an art than a science. And what AI is very good at, much like technology going all the way back thousands of years, is taking information and spitting an output. And so ultimately, will it be able to do our job in the long run? I would be surprised. Are we going to use it to be better at our job? Absolutely. Right. There's absolutely tasks that AI can do better than we, whether it's being done by people or machines or however it's being done today, that can be done better than that. And so it's going to impact our industry like any other. And if you're not constantly thinking about doing things differently, then you're probably going to fall behind. It's really like a lot of technology. It's just going to make people that are creative thinkers more powerful, and people that are doing kind of redundant, more algorithmic jobs less relevant. And we're going to be very eager about incorporating that, and we are in kind of our day-to-day operations, as well as when we talk to companies, understanding how they're thinking about it and how it's going to impact their industries. And it's going to be very disruptive, right? People are going to lose jobs, and that's never an easy thing. But in the long run, you're either moving forward or you're getting eaten by the sharks. And we only want to be invested in companies that are moving forward. And so it's become a part of the conversation. Again,
Right.
not as a separate sector, but really kind of its involvement in every company that we talk with.
And actually, one follow-up question. We had posted on our Instagram over the weekend, basically asking people what tools they had seen being used. And we got, for the most part, a lot of people said like none, or ChatGPT or Copilot, which were sort of like, well, duh. But is there any tool that you have found has been very helpful that incorporates AI that you use? And again, if it's like, this is state secrets, we won't share that, or if, but I'm curious if there's any tool you've seen that is helpful.
So what I tell you is we've done a lot of testing and we have a lot of ideas. I think as we grow and have more resources, it's going to be a huge part of what we invest that in. And so I'm not going to give all those away because those are kind of more proprietary in nature.
Yep.
But I think there's aspects of our job, like building a model, for example, that I don't think AI is going to replace, because you can get a sell side model from someone that built it in India today if you want. And we will get that. But I find a lot of value in actually doing it yourself and learning by doing, and that aspect of it,
Yep.
until they can implant that in your brain,
Yep.
I think learning by doing is still the best way to do it. But there are a lot of things that the process is not as important, and
Yep.
that AI can replace that and ultimately will be better at. And so that's how we're going to be incorporating it in our day-to-day work.
Yep. No, I love that you said that, because I say that to everyone. It's like, just like you're still going to write things down, like the, computer didn't replace people actually writing things pen and paper, or the fact that like ChatGPT can write something, like the act of writing something is how you learn it. I mean, if I get a company's financials, like I need to build my own model if I want to understand how it, like seeing somebody else's or a sell side research analyst model, like, okay, but like building it is a totally different thing. So anyway, I agree with you there. I guess to round this out, is there any piece of advice that you would give to some of our younger listeners, or anything that people should be aware of if they are interested in going into public equities?
I think that what I tell you is the access to information today is so much greater than when we were at Brown. It's not like 50% greater. It's like 50 times greater, right? In terms of what's available on the internet with audiobooks, podcasts, you name it. And so, if you're aspiring to be in this space, you really have to lean into it. You really have to read books. You got to get on Spotify and listen to podcasts. You have to do all these things and realize that like when we were their age, it wasn't anywhere near the same degree. If you're not taking advantage of that, you're probably falling behind your generation. And so that'd be just the biggest piece of advice.
That's such an interesting way of putting it. It's funny because like, I think that the view that Jen and I had was, oh my gosh, I can't believe, these private equity firms or whoever are asking kids to build like a paper LBO and all this stuff. And then it's like, to your point, I mean, that's kind of how you show you care, because it's information that is easily accessible. So like, it's not actually that far out of bounds. It's just showing that you cared enough to look into it and walk in and be able to do it, because it's going to be asked of you. I don't know. So I appreciate that you said that, because it sort of changed my thinking.
Yeah, no, I've talked to, I talk to a lot of high school and college kids that reach out, and I try to always make time for them. And I'm just blown away because what they're doing and what they know, it's just very
wild.
different than when we were in school. It's just
It's
completely
wild.
different. And that's going to be our competition down the road. They're going to be joining the workforce. So it keeps us, honest that we have to constantly improve and get better, because the next wave of people are going to be that much smarter.
I love that. Well, thank you so much, David.
Thank you,
Of course.
David.
Thank
It was
you,
wonderful
guys.
meeting you.
Great meeting you as well. And thank you for doing this.
All right. Bye.
All right. Take care.
Bye.